Hi, everyone. Let's go through a couple of different retirement scenarios or strategies that you can consider. So if you can see this scary looking spreadsheet here, let me simplify it to make it easier to read. Let's assume that we start our working careers in 1980 and we go until 2020, and each year we're going to save $1,000. Well, if we go with the strategy of saving our money in a safe deposit at home, in year one, we'll have $1,000. And then in year two, in 1981, we'll have $2,000. And by the time we reach retirement in 2020, we'll have $41,000 in the safe deposit, representing $1,000 for each of the 41 years that we worked. That's pretty nice and simple and easy to understand. Let's consider an alternative strategy here. Let's assume that instead of putting money into the safe deposit at home, that we deposit it into a savings account with a bank. We put in $1,000 in 1980 in our first year of working, and the 2% interest that we earn provides $20 in income, which we keep in the account. And in year two, we add an extra $1,000, and then we earn 2% on the total to give us $2,060. And then by 2020, we'll have about $64,000 in our savings account, and we've put in $41,000 over the years. So about $23,000 worth of interest is the gain that we've achieved from depositing our money into a savings account. So that $23,000 is basically the way that the bank says thank you to us for lending them our money, because a savings deposit is basically a form of a loan that we give to the bank. Now, instead of lending to the bank, we can lend to the federal government by buying U.S. Treasury bonds. Buying a U.S. Treasury bond is effectively lending money to the U.S. government. And let's say that the government is paying us 4% on the bonds that we buy. Let's further assume, for this example, that every time we receive interest from the government, that we buy more bonds with it. So in year one, we've invested $1,000 buying U.S. Treasury bonds, and we've been paid $40 in interest. The next year, in 1981, we add an additional $1,000, and we earn 4% interest on the total, giving us $122 in interest that we've used to buy additional Treasury bonds. Using this strategy, by the end of our careers in 2020, we'll have $104,000 worth of U.S. Treasury bonds, which is about 2.5 times greater than what we made from just keeping cash at home. So instead of buying a U.S. Treasury bond, we could invest our money in the stock market. And the S&P 500 is a stock index that represents the U.S. economy. And when people talk about the stock market, they often refer to the S&P 500. So for this video, you don't have to really know the difference between this S&P 500 and the stock market. They're often used synonymously, but we'll be more precise defining that in a future video. For this video, let's assume in this strategy that every year we invest $1,000 into the stock market, and by the end of our career in 2020, we'll have $356,000, which is about 9 times what we would have made if we had kept our money in a safe deposit at home, and about 3.5 times more than buying U.S. Treasury bonds every year. Now, you'll see that in this strategy, will actually suffer losses occasionally. For example, in 1999, our stock portfolio would have been worth $117,000, but by the end of 2002, it's worth only $72,000 because the stock market went down. There was a recession around that time. And if you were retiring around the early 2000s and you had a lot of money in the stock market, this would have been a painful hit. Similarly, during the Great Recession in 2008, you would have had a big loss from the previous year because the stock market went down again because of the financial crisis. However, the stock market did recover in subsequent years, and that's why we ended up with $356,000. Let's assume another scenario. We're still investing in the stock market, but this time we're going to reinvest dividends. So dividends are payments by the company to shareholders like us out of the profits that they earn. So if Apple earns $1 billion in profits in 1 year, it could pay us, say, $200 million in dividends. And by reinvesting dividends, we are buying more shares in the stock market. So we're basically increasing our retirement allocation into stocks. And with this strategy, the dividend reinvestment plan, we would have still suffered losses during downturns in the stock market, but at the end of our careers, we would have $735,000 in our stock portfolio, which is significantly more than any other strategy. It's about double the strategy of just buying stocks and then not reinvesting dividends and using the dividends to go shopping or buy other types of assets. So this is the reason why the stock market is considered such an incredible wealth creation machine. Obviously, there's risks. There's no guarantee that future results will be as good as what we've experienced in the last 40 years. They could be worse, perhaps even significantly worse. So let's consider a final strategy with that warning in mind. And in this strategy, we've asked a financial advisor to advise us on the types of investments that we're going to make. Now, financial advisors typically charge a fee between 0.5% and 1%. And this fee is applied to the entire asset, to the entire portfolio that the financial advisor helps us manage. So what this means is at the end of every year, we'll be paying 1% of our stock portfolio to the financial advisor. And so as our stock portfolio increases, the amount of money that we pay to the financial advisor will also increase. If our portfolio falls in value, then the amount of fees that we pay to the financial advisor will also fall. But in any case, every year we're paying them 1% of our stock portfolio. And at the end of our careers, investing in stocks and reinvesting dividends, we'll have $542,000 worth of stocks in our portfolio. You'll see this is about a $200,000 difference with the strategy where we don't have a financial advisor, but we've invested in stocks and reinvested dividends. So the difference of $200,000 has gone to the financial advisor. We've basically paid them $200,000 over the course of our careers. So there's a lot of questions we can ask about these various strategies. For example, why does a U.S. Treasury bond pay more than a savings account? Why did stocks do so much better than bonds over this time period? What's the best way to invest in stocks? What's the best way to invest in bonds? What's the best balance between stocks and bonds and cash? Does it ever make sense not to invest in stocks? What are the risks of investing in stocks? And let me take a moment just to show you the data that I used for the stock market data. It comes from this website called the Motley Fool. So we're going to discuss this in future videos. In the meantime, I hope this gives you some things to think about, and thanks. I'll see you on the next video.